Hey everybody, welcome to the Thursday evening live stream. Hope you guys are well. We have a special guest this evening in the series of May special peer-to-peer lending guests. Steve Robson of Capitalstackers. He is the managing director. We'll be here in just a few minutes. If you can hit that thumbs up, I appreciate it. Let's see how many. Oh, we only have 2 thumbs up right now, so please go ahead and just press that button. It takes a second, helps me out a lot, helps the channel out a lot. And we'll get to Steve Robson in a minute. Of course, Capitalstackers, something really wasn't on my radar for a while, and then Steve and I began communicating, and pretty interesting proposition that they have there peer-to-peer lending-wise. And what really got me interested in Capitalstackers was when I talked to Steve. He showed me this the amount of due diligence that Capitalstackers goes through to bring loans to the platform, and I've never really seen that type of due diligence from one single person before. So I thought, I got to get him on the stream here live so we could talk to him about what he's up to over there, and bring some light on what I would say is not. They're not really out in the forefront as much as some of the other companies like Cufflink. Speaking of Cufflink, of course, Cufflink is sponsoring this stream. Earn up to 9.73% gross per annum, over £250 million of property-backed peer-to-peer loans, and UK investments made since 2016. Zero investor losses to date. Capital at risk. Please don't invest more than you're prepared to lose. You can sign up at join.cufflink.com/financial-thing. A big friend of the show. Thank you to Cufflink for sponsoring this live stream, and also sponsoring the Harley cam right there. She is snoozing, waiting for Steve to get here with bated puppy breath. Don't forget, next week we have Peter Reed from Assets Exchange. He'll be here live, kind of giving us an update on what's going on with Assets Exchange. And then in July, I'll be taking a little bit of time off, so you'll not get to see my beautiful face for a bit. I think from the second week in July, let me look at the dates here just so I can give you an idea of next month's streaming schedule. Let's see, July. Where's July? So I will be off stream from, we'll do a stream on the 6th of July. Sorry, we're talking about June, never mind. We'll do a stream on the 1st of June, then maybe on the 7th of June on a Wednesday, before I will be taking time off until the end of the month. So, and then back, we'll have some more guests on, I would imagine, late July, August. So we'll get back to the regular programming then. So you'll just have to watch some archived video footage while I'm away. I'm going to be coming over to England, taking a bit of a holiday, a well-needed break. But anyway, welcome to everybody. Thank you for joining. Again, if you're not subscribed to the channel, please subscribe to the channel and all that good stuff. Yeah, so let's go ahead and bring Mr. Steve Robson in. Just bear with me for 1 second while I get him in here. He said, please be gentle on me, which I will try to do. So let's see. Here we go. Hang on. Hello, Steve.
Lawrence, good evening.
There he is. Afternoon. Good evening to you, afternoon to me. You are live now on our Thursday evening peer-to-peer lending live stream. So thank you again for agreeing to be thrown to the wolves. No, just kidding. We won't do that to you. I appreciate you being here, though.
Yeah, I thought it was the dragon's den, not the wolf's den.
No, definitely no dragons here. Just a bunch of interested investors. I know some of the people in the stream actually already are Capitalstackers investors, and we got some people that are interested in learning more about what you're doing over there. So I just want to state too, for transparency purposes, this is not a paid thing that we're doing. It's just out of interest of what I have for Capitalstackers, and Steve wanting to let you guys know about what he's doing. So, and I personally don't invest through Capitalstackers at the moment, so just throw that out there for transparency reasons. But let's get into it, Steve. Let's talk about capital stackers. Sound good? And peer-to-peer lending.
Yep.
All
Let's see
right.
if I can persuade you, Lawrence.
You never know. You never know. I'm waiting for my tax refund, and then I might have a few. What do they call it? Spindulocks. I don't know. They have a slang word for pounds that somebody told me about the other day. I think he said it was like spindoolies or
Spondoolies.
Spondoolies.
Yeah.
Yes.
Never used the phrase. Never.
Never? Well, there you go. So maybe I'll have a few Spondoolies to put into capital stackers once HMRC cuts me some grace. But anyway, let's get into it. Capital Stackers, of course, you are the managing director. Is that correct? The MD.
That's true. Yeah.
Okay. Can you give me, Steve, a brief summary of your property lending professional experience before you got involved with Capital Stackers?
Yeah, sure. I left school and went into banking and was a career banker up until 2008 when the market crashed. So I've been involved in doing real estate finance for 30 odd years, 35 years actually. Time flies. I know I don't look old enough, but I'm past retirement date. Certainly past a banker's retirement date. So I've worked for Handelsbanken, Hyperbank, RBS, Singer and Friedlander, and then latterly Macquarie. And in those roles, that was from the mid-80s, I was doing real estate finance. So development lending, investment lending, covering a range of products such as residential development, student accommodation, commercial, and so on. So quite a wide and varied career.
You got some extensive experience. And I will say, by the way, you're the first person to come on the stream that actually had a microphone. It's pretty amazing.
Really?
So
maybe
groundbreaking.
Maybe it's because it sat on this box. Top tip from Lawrence.
It sounds so much better too. No, I mean, usually you could tell when people are using laptop speakers and microphones, and I always tell people just don't do that because they never sound good. So well done for doing that. So tell me, Steve, when did Capital Stackers launch its first loan?
That was 2014. One of our shareholders is a firm of accountants, and we were discussing whether or not they would get involved in the firm. And they wanted to see the product working. I mean, it was fairly new as peer-to-peer lending, even in 2014. And they said that they would join in with us if we could prove to them that we could, A, find borrowers, and B, find investors. So I had two of my former borrowers that said they would put a deal on the platform, one a development, one an investment, and then we filled a room at the accountant's office, firm of accountants in Stockport, Hallidays. And on the back of that, we did the two deals, and they ended up backing the business.
And did you say, am I right in saying that the picture behind you on your background is actually one of the first deals that you did?
Development that we deal in Wandsworth. So that was for a developer that I've known for many years, and it was a conversion of a police station. That's the older building, and then two new house builds adjacent.
Was that the first deal behind you, or was that one of the early ones?
That's the first deal.
So that's you go.
The very first deal.
That's historical.
Yeah, it is.
That's pretty cool that you have that picture as your background. And so for anybody that's not familiar with Capital Stackers, can you sort of just explain what exactly you offer to investors, what type of lending products?
Yeah, it's all real estate, and the majority of what we do is residential development. Some schemes that we do are mixed, and therefore there's some commercial element to it. We've done a couple of purely commercial deals as well. We focus on the junior debt space. I know that's a part of the capital stack that you're averse to. But the genesis of Capital Stackers was to fill the gap left behind when the banks pulled their horns in. So it was born out of necessity, really. So we do the junior debt space. That's not to say that we can't do senior debt. We've got a couple of deals on the platform at the moment that have got first charge security, but that's rare for us. And if we do that, we make sure that we raise the funds all on day one.
So you're mainly dealing then in that junior, which is which obviously would pay higher interest because it's considered to be a little more risky because it isn't in that junior position.
Yeah, well, it is more risky.
Yes.
Let's not beat about the bush. It's more risky, and therefore it carries higher rates. Yeah.
Well, I don't know. I'll say that some of the loans that I've seen on some platforms that are first position have been pretty damn risky too. That pay 6%.
A bit shaky as well. Yeah.
Yeah.
We also have the ability to layer the risk. So in the same way that you would differentiate between senior and junior debt, we can layer the risk up to 5 times so that somebody sitting at the top of the stack in first loss position can get a substantially higher return than those people at the bottom of the stack in last loss position.
Okay, that makes sense. Right now, what is the size of Capitalstackers' loan book, and what type of interest returns can an investor approximate that they might get?
16.5 million, which doesn't sound a lot compared to the competition. But if you take into account the senior debt that sits below that, the total funding that we've got against properties that we're financing, including the banks that are working with us, that's about 100 million. The average return on the bit that we do, the investors are getting 14.3.
Okay.
But that disguises quite a wide range. At the bottom end, just a shade below 7%, but that's for first charge risk, obviously, up to 30% on one of our more leveraged deals.
Okay. And what is the minimum investment amount that somebody would need to make to get into these loans?
£2,500.
Okay, 2,500.
Yeah.
Have you ever considered reducing that to a lower amount, or is there a method behind the madness of making it higher?
It's a constant debate internally, but that's only just reduced from 5,000.
Okay.
So it was in December last year when we introduced our IFI set that we decided that we'd reduce the amount so that people could have a wider spread on their £20,000 annual allowance.
Okay.
And we may reduce it in the future, but we've got no immediate plans to do that.
Okay. One of the things that really impressed me when we had spoken a few weeks about you coming onto the stream was you showed me this spreadsheet, and I've never seen a spreadsheet that had so many intricate parts to it, calculations, tabs. It was really impressive. I don't know, it must have taken you a long time to make a spreadsheet like that. But this spreadsheet is part of the screening process that you go through when you're looking at deals. And I know Capitalstackers really, you said, takes pride in the amount of due diligence that they do when they are looking at bringing a loan onto the platform, because you're bringing on loans and you have this responsibility that you want to put forth the best product you can, because I know you'd said you care about investors' money and that's important to you. Can you just explain to me what type of screening process so people watching can understand what it is you go through to get a loan onto the platform?
Sure. The spreadsheet that you refer to, it's quite a sophisticated financial model. I guess most people out there doing what we do will have a spreadsheet of sorts. And typically they would be working from appraisals that are produced by developers. That's the start. The source document, obviously, is the development appraisal. And that's assuming, of course, that a deal passes the sniff test, and it doesn't always. I would guess that we convert probably less than 5% of the deals that we look at by number or volume. You have to kiss a lot of frogs in this game. So our start point is to do the sniff test. If it passes the sniff test, we'll look for more information, engage with the developer to listen to their story about what they plan to do with the site, how long it's going to take to build, what the costs of the build are, who they're anticipating selling to and over what period. And then we take all that information and put it into our financial model, which compares what the developer's view of life is to what our view of life could be in a downside scenario. So, for example, if a developer says it's going to take 15 months to build, we'll probably build in at least 16 months and maybe 17 or 18. If he thinks he's going to be selling off plan a substantial proportion and then the remainder over 3 to 6 months, we'll assume no sales off plan and probably a 12-month sales tail with a delay after practical completion. So the net effect of all of that is that we're looking at a higher interest cost. And in today's environment, the funding costs on an appraisal are a significant proportion, much higher than they ever used to be. It used to be that land was a substantial proportion, but the number of appraisals that we look at, the land costs less than the funding. So
just,
all
just
of that
explain to everybody out there who may not know what that means, an appraisal.
The appraisal is simply what a developer is looking to sell for, deduct from that how much you have to pay for the land, how much it's going to cost to build, what the professional fees are, and what that developer wants to make in terms of profit. That's going to determine how much he's prepared to pay for the site.
Okay.
Most developers are looking for a 20 to 25% profit on cost, depending on how comfortable they are with the site and the prospects for getting out when it's finished.
Yeah.
So I guess the spreadsheet that I showed you a few weeks ago is an appraisal. It's essentially that, but what it allows us to do is to compare the view that the developer has side by side with the view that we have, and that gives our investors that bit more of an insight into how the thing might pan out. But don't get me wrong on this, Lawrence. We build in some downside sensitivity, but we do have examples of where the reality has been way beyond what a developer expected, and similarly beyond what we expected too.
Okay. So, yeah, I mean, in my experience with the real estate world, they always say whatever you think, add 20% time, add 20% cost, blah, blah, blah,
Yeah.
right? Would you say that's pretty accurate?
Maybe,
always.
maybe not. It depends. You see, there are no two deals that are the same.
Yeah.
We've got a very wide spectrum of risk and reward, and that's partly the reason why we don't do a pooled lending offer. Everything that we do is direct lending. Investors choose where they want to participate, not only by deal, but also within the deal at which layer they want to participate.
Capitalstackers has this approach called you told me it was a fully funded approach. Can you explain what that means?
Yeah. Well, it's driven mainly by us being in the junior debt position was a key driver. Immediately post credit crunch, banks that used to lend 75% of value, and I've worked for a few of them, and would call that senior debt and would be quite comfortable in that position. Post credit crunch, the amounts that they were lending were typically 50%. You got an aggressive bank if they were lending 60% of value post-credit crunch. And you've got the same number of developers with good quality projects that simply could not get funding. So pre-Capitalstackers, I would work the phones trying to introduce high net worth investors that I knew through my banking life with developers that had got good projects. And it was like drawing teeth. I should have been a dentist. So we decided that what we needed was a platform that would bring together multiple investors at the same time to participate in the same deals. Now, when we decided that we'd push forward with a platform, we had lots of internal debate about whether or not you would do tranche funding, i.e. raise cash every month to pay a contractor. And lots of our competition in the senior debt space would probably do that, not monthly, but maybe they'd raise funds on a 2-monthly or maybe even a 3-monthly basis. We didn't like that risk. I couldn't get comfortable with the potential of having to raise funds from a market that may not be there. So our view of life was, let's work with those people, i.e. banks and debt funds that have got the appetite and the ability to lend. So they provide all the liquidity for construction, and the funds that we raise on day one will be deployed on day one and generating an income on day one. And even in the senior debt space, and the reason why we don't do much senior debt is because we're not competitive, because if a developer borrows from a bank, they're paying interest on the amounts that they're drawing down. Whereas with us, because of this mantra that we have about not taking the construction liquidity risk, we raise the funds on day one in their entirety. Okay. So there are very few deals that would benefit from doing it that way.
Okay. Steve, what is the average loan size tend to be that you're offering to investors?
It's around about, historically, it's around about the £600,000 mark. We've just launched one today. That's just gone. So it's gone live on the platform today, ready for bidding to start on Sunday. And that's closer to £2 million. So the range that we've done, the largest loan that we've done is £2.25 million, but that was substantially underwritten by a single investor. And the smallest deal that we've done historically has been 150,000. At the moment, our sweet spot is between $500,000 and $1 million.
Okay. So do you have, like some of the other peer-to-peer lending companies have a bit of a challenge with a lot of people snapping up large portions of loans and people not being able to get any sort of allocation deals, loans being sold very fast in just a matter of minutes? Is that something that Capitalstackers tends to see, where the loans go quickly?
Yeah, yes, it is. I'm afraid so. It would be great if we had a deal flow and an investor base where deals took half a day or maybe 2 or 3 days to fill. But we don't have that much of a deal flow. We haven't had that much of a deal flow. That's changing. We've never been busier over the past 2 months. So we're seeing more deals coming to us. But the last deal that we published went out within 2 minutes. And summer last year, we had 2 deals that we posted half an hour apart, and they went out in seconds, both of them. So we have investors that will say to us, why can't you put a cap on the bids for the first 5 minutes or so? And that would require a lot more coding. We're a small team, and therefore to invest a lot of time and effort in coding and then testing, that's taking us away from what we should be doing, which is increasing the investor base and increasing the deal flow.
Yeah, coding can be a real pain. I know I hear that's one of the biggest challenges. People say, "Oh, can you just add this and just make this?" And they don't understand exactly how difficult it is.
We've had investors come to us from those platforms that have introduced auto bidding, for example, where they're higher net worth investors with more cash to invest and need somewhere to deploy it. And if we look back at our history and you look at our average investment size, we're almost up at £100,000 for the average investor. There is a strong argument for saying that we need to service the people that have made the platform successful. And if that means that there needs to be a bit of a dust up and it's a fastest finger first situation when we launch a deal, then I would just ask our investors, our smaller investors, to stay with us during that process, and we will undertake to generate a larger deal flow so that it will pan out ultimately.
So if the deals are going really quickly, do you actually need to have cash sitting in your account to be able to bid? Because I know you have a bidding process, and maybe you can just explain how the bidding, I know there's an agreed bid and a non-agreed bid process. Can you just explain how that process works and whether a customer needs to have money in their account to bid?
So to answer the last part of that question first, the answer is no. You don't need money in your account to bid in the primary market. You do in the secondary market. We can come back to that in a second. But in the primary market, you don't need money to bid. What you're essentially doing is a pledge. And the main reason for doing that is that the bidding process and selling the deal out is the first stage of actually getting a deal converted. It's the second stage in the deal's progress, because obviously the initial stages is where we're doing the assessment and making sure that we're happy with publishing the deal. But once the deal's on the platform, investors will bid for it when we know that that deal is going to be successful. And the average deal size that we do is quite high compared with some of the other platforms. So we want to make sure that the deal will work. And more importantly, a developer will want to make sure that he's not paying money for valuations and monitoring surveyors, reports and legal costs if we fail to come up with the goods. So the pledge is made. We then instruct the valuer, monitoring surveyor and lawyers. At that point, the developer is more comfortable in underwriting those costs in case it becomes abortive during due diligence. And then around about a week or so before we anticipate that we'll be completing the deal, that's when we ask for the cash. So investors would then credit their platform wallet, and then we sweep those wallets and complete the deal. Now in the secondary market, because deals are instantaneous, an investor needs to pre-fund their wallet before they buy.
Okay, well, that makes a lot of sense. Again, we have Steve Robson here. He's the Managing Director of Capitalstackers UK peer-to-peer lending company. You can go to capitalstackers.com if you want to check out the website, sign up, get yourself a free account, see what's going on. I just want to ask you another question, going back to you talking about the junior lending side. Who are the senior lenders on these types of projects generally?
Typically, it's the challenger banks. So we've done business with Hampshire Trust Bank, United Trust Bank, Shawbrook, Oak North. Apologies to anybody who I missed from that list, but I just want to give you a flavour. Ideally a bank. In the early stages, we were requested to put funds behind some of the larger platforms, such as RateSetter, who were into development finance. And we thought very long and hard about doing that. We came close to doing one deal, which didn't happen. But there's a touch of hypocrisy if we say we're not going to take the risk of the crowd running away from deals in the future to actually fund with a peer-to-peer platform. So we're quite strict now. We work with banks and we work with debt funds that have got some financial muscle and the ability to follow through.
Was it hard? I mean, generally within our sector, within peer-to-peer lending, you don't tend to have companies working alongside the banks because really peer-to-peer was created to sidestep the challenges of high street bank lending. I know you said you're doing challenger banks. Was it hard to get your foot in the door?
Yes.
Did you have?
Yes,
I figured maybe you had some existing relationships with.
Well, we
people
had those.
In the banking, because of your experience.
We had existing relationships, but it wasn't an easy route to getting the deal away. But I think there's in the institutions generally, and I include banks within the institutional market, there's a sort of care, consideration around working with peer-to-peer platforms. I mean, the peer-to-peer sector is really new. It's a very nascent industry, isn't it? Mm-hmm. And there is a huge amount of mistrust born on the back of all those platforms that failed miserably.
Yes.
So with those platforms that are still running, have to work quite hard, I think. It's getting better. Mm-hmm. But the point has come now where we've done multiple repeat deals with the same senior debt lenders, to the point where we introduce business to each other. Because if you think of it this way, the legacy to the banking industry of the 2008 financial crash was a tightening regulatory screw, is that it will be a long time, if ever, that banks are doing 75% loan to value. The sort of pegged back at 60 to 65% loan to value. And yet the developers have got the same finite amount of equity to put into deals, and therefore there is a real genuine gap that needs to be filled. And that was the whole rationale behind Capitalstackers, to plug that gap.
It's always good to be able to plug a gap, when you see one. So.
Absolutely.
I was just taking a look at your statistics page on the website before I was talking to you this evening, and just going to bring this up on the screen so people can see. There's a pretty extensive loan statistic page if you want to, if you're a numbers person and you like statistics. That's pretty cool. There was one thing on here I didn't really understand I wanted to ask you about. There's a thing called connected investment here. It's about 6 or 7 items down. It says current 25.6%, cumulative 28.2%. Can you explain, Steve, what a connected investment means on your statistics?
Yeah, sure. It means me, my colleagues, people within Halliday's, the accountants that are part of the business. It's money that we put into the deals personally. So that's the management team. Think of it as the management team and their close family, spouses and partners. Mm-hmm. So about a quarter of the book is funded by us. It's an important part of our own personal investment. If we included in that statistic our siblings, and other wider familial connections, that would be over 30%. Mm-hmm. So it's proper, real skin in the game, and there are no special circumstances surrounding those investments. We actually bid. We have to play the fastest finger first game alongside our investors.
I was gonna ask you about that too. So, if there has been a bit of an issue with loans selling too fast, why do you guys not decide to say we're going to take less of a percentage connected. So basically,
We do.
Yeah.
We,
Do you
we
ever
do.
say
We
we're going
do
to scale
lots.
back that?
Yeah, we do. But I think part of our pitch is that we take the same risk as our investors, and therefore, if we stop doing that, it's no longer part of our pitch. What we do is hang back a bit and let the investors, have a play initially, and then we'll come in and, if necessary, do some of the mopping up.
Okay.
But I think it's important that if we talk about sharing the risk, if we have a layered deal where we're only participating in the lower layers, that's not really sharing the risk in the upper layers. So, and I come back to the point that I made earlier. What we need to do is find more deals.
Yeah. And so I always have to say, too, I don't think a lot of people really appreciate how difficult it is to do what, not only you at Capitalstackers are doing, but making a business where you're having to balance this lending, borrower, investor side of things to keep it equally balanced. Go out and find new business because sometimes the loan business is not necessarily reoccurring. Some companies only do one loan a year or every few years, so they're not coming back all the time. Of course, you're going to get your borrowers that come back again and again and again, multiple times, some of the bigger developers. But I know how difficult it is because obviously speaking to as many peer-to-peer companies as I have over the years, I kind of just wanted to say, well, credit to you for being able to build this business and do what you do and to provide these investment returns in a time where we're still only getting 3.5% interest in the bank. So hats off to you and to all the other peer-to-peer companies that are doing good things out there because it is not easy. And I don't know, how many employees does Capitalstackers have, by the way?
We're a small team. So former bankers, number 4 people. Our IT department is essentially one man, but a team of developers that are on subcontract arrangements. Then all the admin is dealt with by people within Holidays, the accountants. We outsource our cash collection and onboarding to Goji Investments, as do a number of other platforms. And that was a massive relief. We did that in 2021. Prior to that, we were doing everything. So we've got the resources to do what we do at this sort of level without much of a problem. In fact, we could probably increase the loan book a bit. If we increase it much more, we'd need to take on board more headcount.
Yeah.
But we haven't chased growth. We're a proper bootstrap business. We've got no external funding other than the initial funding that was injected by Holidays when they came on board. We cut our cloth, which means that we don't carry any extra overhead in anticipation of growth. We'll do the growth and then we'll take on board the overhead. So we've never made a loss. We've always been profitable, and that's how we intend to stay.
Yeah, and I think there's something to be said to keeping the staff levels at a very, very low and manageable number, just from a profitability level. Because we've seen some of the bigger companies with 100 staff members, and seems like they've had trouble sustaining their companies. So.
Yeah, exactly. And there are enough challenges in this sector without layering on more risk.
It's definitely true. That's a lot of tea bags if you have 100 people working for you. That's a lot of tea you've got to provide.
Yeah.
Tea's not cheap these days.
I think their tea bags probably cost more than our marketing budget.
Let's talk about default rates, because it's something obviously everybody wants to know about. What has Capitalstackers' default rates been like historically? And I know defaults can mean different things. The FCA has their own, what they consider defaults. Maybe you have a different way you look at defaults, but What do the
Yeah,
historical default rates mean?
Defaults mean different things to different people. You've got that absolutely right. So technically, if somebody, if the loan to value ratio on a deal moves in excess of the covenant, that's a default. Or should I say it's a breach of covenant, which could come a default. If a deal runs beyond its loan maturity date, the documented maturity date, then that's an event of default, which could become a default. I think the right way to measure default so that you can compare like with like is the level of losses. How much has an investor lost in either capital or interest? And touch wood, so far we've got 0 investor losses. That doesn't mean to say that we haven't had deals that have run late. On the stats page that you referred to earlier, there's a nice scatter chart on there that shows the deal sizes and how much over their maturity date they've run. And we've had a couple of deals that have run substantially over their maturity date. A lot of that was pandemic driven, but the investors still got out. And defaults are used to go and trigger deals. Bridging companies, I'm not talking about the peer-to-peer world, although it may apply to the peer-to-peer world, but bridging companies would tend to lend for short periods on the expectation that they're financing somebody who is buying a property, looking to refinance it or sell it, and those deals tend to be shorter tenure. And if you run beyond, then that's a default, and the interest rate flies through the roof, and it's a really good way of making money. That's not how it works in development finance, because there's almost an expectation that if you write a loan for a certain term, you're not going to be surprised if it's going to run over that maturity period. So setting the term of the loan, from our perspective, is effectively setting a control mechanism. So you could avoid even the FCA's 6 months beyond the maturity definition of a default. You could get rid of that at a stroke by writing a loan term of 36 months for a deal that you think is going to repay in 24 months. And I'm not saying people do that, but I'd rather set, if I thought a deal was going to be repaying in 24 months with some contingencies in there, I'd rather set the loan term at 22 months or 20 months, knowing that I can then start rattling the cage at the developer if it's not performing.
Mm-hmm. Somebody in the chat just quite timely asked a question, which I think is pretty interesting. I'll just pop it up on the screen. This is, do lenders get any default premiums if the loan overruns? Is there any premium paid on those defaults?
Yeah, if we call a default, so typically the default interest on top of the standard, in inverted commas, interest would be 4% for us. So if we have a borrower where things aren't going according to plan, where we've exhausted the forbearance that lenders are asked to give borrowers in today's environment, and that interest is triggered, then we'll charge that in due course and pay that over 100% to the investors.
Okay, that's very cool.
But just to be clear about that, I can count on the fingers of one hand where we've thought it necessary to actually charge default interest.
Yeah.
Because if you have a borrower that has fallen on hard times, things have gone against for whatever reason. For example, a contractor may have gone bust, but the developers worked really hard to find an alternative contractor, and they're not throwing the keys back at you, and they're staying involved and engaged. Then they, in our opinion, deserve the support that we can give them, and we would hope that our investors would buy into that as a concept, because you never improve the situation by appointing a receiver or an administrator. The one thing that you can be cocksure of in those circumstances is that costs are going to go up and it's going to become very protracted. And I guess there are a number of people that are listening to this now that have got live experience of investments that they've made through other platforms that have gone into administration, and I bet they're tearing their hair out.
Yeah, myself included. I think I just got a payment back from one of the defaulted platforms that was about, I'm thinking about the percentage of what I invested, 3%, I think was what I got back. So that would,
ouch.
that's some pull the hair out, tear stuff. So
Yeah.
okay.
I have to say, Lawrence,
yeah,
that I
tell
did
me.
have a full head of hair when I started this game.
But your head of hair was not lost because of the money from defaulted administration platforms that you.
No, it wasn't.
So.
It was for different circumstances.
There you go. That's good. Tell me, we've seen some of the platforms steer away from retail lending. They've gone institutional, a number of them, especially the bigger ones. What's Capitalstackers' stance on continuing to serve the retail sector of peer-to-peer lending?
Whilst ever I'm in charge, we'll stay very firmly loyal to the retail investor base. We wouldn't be where we are without retail investors. We have spoken on numerous occasions to institutional investors who quite like the product, quite like the management team and the way that we do things. But when it gets to not dancing around the handbags and talking about a proper legal engagement, the discussion always comes around to the fact that they want us to do it their way as opposed to them doing it our way. And by that, I mean that the institutions don't like mixing their cash with retail money. The only reason that we can try and fathom around that is that they believe that there's a reputational risk, so that if they're involved in a deal that retail investors are involved in and that deal goes pear-shaped, they get tarred by association of probably being, one of the parties that could have potentially put more money into the deal or saved it or whatever their rationale for it. It doesn't suit the way that we want to do business. So we'd be delighted if there were one or two institutional funders out there that would participate alongside our retail investors. And by that, I mean in the same deal, not on the same platform in separate deals, but in the same deal. Because what that would allow us to do is to crank up the activity, provide more deals, and ultimately that would mean more investment opportunities and a better ability to diversify for our retail investors. But we're really quite wedded to the idea that an institution would have to invest in the same way that our retail investors do, apart from one thing: they wouldn't need a fastest finger. They would be underwriting larger deals on day one, and with an understanding that they could then use the secondary market to go and feed the retail investors as well. So
yeah,
I don't know where those discussions will end up, Lawrence. We can live in hope, but if that doesn't happen, we'll continue what we're doing. We'll continue to manage the lack of critical mass, because I don't think a peer-to-peer platform can ever master that.
Yeah, no, absolutely not. But there's a couple of comments that I was reading while I'm listening to you too, but I'm still paying very close attention to what you're saying, Steve. By the way, if you haven't hit that thumbs up, please do. Show Steve your support. He's taking time out of his evening to come and give us all this free information direct from the horse's mouth. So please do that. Please hit that thumbs up and subscribe. A couple of comments here. Somebody said, I think Lawrence needs to sign up for Capitalstackers. That's probably a good point. I probably should do that. The other person said, Olivia Reed, the one downside about capital stackers is loans often substantially overrun. My concern is that they are soft on lenders. And I think you've already sort of broached upon this subject, and this is really a standard thing within development finance. Is things are very, very fluid. Developers often need extra time to continue on with their projects, and it's like you can't rule with an iron fist when it comes to lending. Every circumstance is different. Obviously, if you see somebody's not going to pay you back, you have to take action. But action in the lending world is really the last thing that you want to do because it's expensive, it's time consuming, and it generally doesn't always end well. So I think, I can certainly speak from other lending companies that I've spoken to. They just have to be flexible with the goal that they want that developer to succeed, and that they tend to do everything they can to support the developer to getting the project to completion and then getting the money back. Would that be a correct synopsis?
I think that is really well put, Lawrence. I have yet to meet an LPA receiver or an administrator that would make a better fist of it than a developer that has that is really at his wit's end with a deal. And if a developer, if a borrower is cooperating and doing the right thing, then we'll support them. But whoever's asked the question, if they want to give me a call, I will introduce them to a couple of our borrowers where they can ask the question, do you think Capital Stackers is soft on us? Because we can keep the feet to the fire, put it that way. Mm-hmm. But you can keep the feet to the fire and still be supportive. And if the outcome of the deal is that you're earning interest for a longer period, but you're getting your capital and interest is delayed, that to me is a far better solution than crystallizing a potential loss.
I agree. Good. I think that's a really good statement. Let's see, how long have we been going for? We're going on less than an hour. I'm just going to ask you a couple more questions because I don't want to keep you here forever. But I think it's been a really interesting discussion. Steve, obviously we've seen too many companies fail. And unfortunately, some of us have been victims of cases of certainly questionable runnings of the companies and mismanagement of loans. What advice can you give to people out there looking to invest in reputable, I use the quotation mark safe because nothing is guaranteed 100% safe, but as safe as they can hope to get within the sector? What advice could you give to people looking to want to lend money into peer-to-peer lending, how they find those reputable companies?
Well, first response to that question is that anybody who is still alive and kicking in the peer-to-peer world now must be doing something right, because we've had the regulatory screw tightened on 2 or 3 occasions. We're all going through the consumer duty enhancements that are taking place and due to go live at the end of July. So the first point I would make is that we're not in the Wild West anymore. But the key to this, I think, is research. And research would start with people like you, having a look at some of the reviews that you're doing. People like Fourth Way and P2P Independent Forum is a really good exchange of purist investors' views where they will trade comments with each other about how platforms are performing. But I would focus on transparency. You can't operate in this game if things are opaque, and we pride ourselves on the amount of transparency that we offer. So look at the statistics, make sure that the team that is managing the platform are steeped in experience around the product that they're providing. So, and to put that into context, Lawrence, I don't know if you've covered this off before previously, but the management of Lendy, before they started doing property development finance, I understand it, read it somewhere in the dim and distant past, is that they used to lend on boats. They were marine lenders, so super yachts and so on. Well, there's a bit of a difference between a super yacht and a property development, and that to me is really critical. And one thing that you can always do, bearing in mind there are no massive platforms left, so nobody can hide behind the fact that they're too big, is pick up the phone and speak to the management. And even the larger platforms, where maybe the management just couldn't field that number of calls, will have teams in place that can field questions and answers. I speak to investors regularly.
Okay. There you have it. So if somebody wanted to get in touch with you, what's the best way?
Just phone the number on the website, and the switchboard will put them through.
There you go. So if you have questions for Capital Stackers, you can speak to Steve yourself and get those questions answered. We're going to do a couple of really quick questions from the comments, and then I'll let you go for your tea. Hopefully you're having something good tonight. Maybe a little
sea bass tonight, Lawrence.
Sea bass? I mean...
Sea bass, yeah.
What, are we talking
sea bass and salad?
Sea bass from the UK coast, like off the coast of Skegness sea bass? Or... No,
I think it's sea bass from Tesco.
Well, that's actually making me really hungry. Well, I'll let you go enjoy your sea bass. A couple of quick questions. When a loan goes live, is there a certain time that you do it? And this is for myself too, because I'm really actually considering signing up for an account. I'm pretty busy, and then I have the time difference issue here. So what time would I have to be on the platform to snag some pieces of loans?
Right. So we publish deals. Let's use an example of one that we did today. So we've got the deal that we published at 1:00 today. Normally we give 48 hours notice before the auction goes live. This one goes live on Sunday, so that's 3 days before that goes live. And we've tried them early in the morning, around midday, and in the evening. So if you play your cards right, Lawrence, and you give them the tip, once you've set up an account, we could do one that means that you don't have to get up in the small hours.
It's probably not such a bad thing for me up in. So probably around 1:00 in the afternoon. Is that what I'm hearing tends to be?
Yeah, that's typical.
Okay.
And there's no science behind that. We've sort of had a debate internally and thought, well, if we do midday, people will be at lunch. If we do 1:00, people will be at lunch. But if you do 1:00, people might be just coming back from lunch or just about to go to lunch. And
okay, cool. Let's see what else here. Capital Stackers, you said is running at a profitable level. You said it has been for a long time.
Yeah.
Cool. Okay, that's why you can have sea bass. Is there a
steady on? Steady on. It's
sea bass
Tesco sea bass.
I mean, it's not cheap. Hang on, let me put this question on the screen. Is there any deal that Steve regrets putting up on the site? You can decline to if you don't want to answer.
I won't give any deal names, of course, but yes, there are a couple of deals. Most business work on the 80-20 principle, don't they? 80% of your time working on 20%. Well, Capitalstackers is no different. We have a fortnightly credit review where the bankers in the team discuss the portfolio, and there are 2, 3, 4 deals that we spend the majority of the time discussing and planning and working the strategy on. Well, it would be very easy to say if we hadn't done those, we'd be much better off. But
you're not going to get it right all the time.
you're not going to get it right. And development finance is got lots and lots of moving parts.
Okay. Let's see, Mike Powell, our esteemed member in Southampton. I think that's what he's usually in the pub watching this, from what I understand. So he's having a good pint of Guinness while he's sitting watching you. He asks, and again, if you can't talk about these things, please, that's okay. What's the capital stackers spread on deals? Looks like you only get paid when the lenders get paid. Is that correct?
Yeah.
Okay.
So if you imagine the repayment, these pesky things, I'm not used to them, Lawrence. If you imagine the way on a typical capital stackers deal, how the repayments go, the bank gets repaid first, then layer 1 investors, followed by layer 2, layer 3, depending on how many layers there are in order, and then we get our margin and the exit fee after investors have been paid.
Okay. And do you want to say what those spreads are like as far as what capital stackers make?
Yeah. So whatever the borrower pays, so in interest, let's say that's 15-16%, we'd be looking to take between 2.75 and 3% of that, with the rest of the interest going to the investors. But for the sake of transparency, there's an awful lot of work goes into setting these deals up and monitoring them. So the arrangement fees and exit fees on a deal that are typical of in the real estate sector, we keep those for ourselves.
Okay. All right. Good. Let's see. Okay. One more, and this is from me to you really quickly. You mentioned that any company that's been around now and managed to survive the screws on the regulation. Do you have any peers within the industry that you think are doing a good job within the peer-to-peer world?
Yeah, your previous interviewees on this question always tend to hedge the bets, don't they? And yeah, I actually really do quite like Proplend, because they've got a good track record. They're one of the longest established. They understand the product very well. I quite like the tranching their A, B, and C. Looks very similar to Capital Stackers. So no, I quite like their product. And there are a couple of others out there as well that obviously peddling quite hard, a bit like the swan on the water.
Okay, so Proplend, nice shout out to the guys over there who have been on the stream a couple of times. I've actually been to their office a couple of years, I think it was probably 3 or 4 years ago. Let's see if there's anything else. Oh yeah, this is I think I might just ask a question that I think I asked you before, and I think I know what the answer is going to be, but do you invest in any of these peer-to-peer platforms yourself? Or does all your money just go back into capital stackers?
All my finances personally are in capital stackers, with the exception of some buy-to-let properties which I am desperate to sell, so that I can put the money into capital stackers.
You want to sell you're saying you have buy-to-let properties that you want to sell?
Yeah, I've got some buy-to-let properties which my other half and I have had since before we started Capital Stackers, and I would really quite like to liquidate those because they're quite painful. They're quite painful from a management point of view. A sight less painful than being an investor in Capital Stackers, that's for sure.
Yeah. Being a landlord is not particularly fun. Okay, well, look, anything else you want to say before we sign off about Capital Stackers or the products that maybe you have a new upcoming lending product, maybe you're just doing the same thing that works for you? Anything else? This is your time to
we're very much into the if it ain't broke, don't fix it mentality. I suppose if I don't know if you can call it a product because it's an extension of what we do, but But until recently, we'd find that deals would redeem in the normal course of events by a developer getting to practical completion and then just selling properties out and repaying. And the cost benefit equation for actually doing a refinance at practical completion never used to suit developers. Well, with the current economic climate and the rate at which sales are taking place, so sales are still happening and they're just taking longer. It's now financially viable for developers to go for sales bridge products, which all the banks are providing. And we're now just looking, in fact, we're about to publish a deal. So it's an existing deal where we're refinancing using part of the bank's money and a new loan on the platform to refinance existing loans. So we'll get some more churn and more ability for investors to participate on something where there is no construction risk. So the pricing is going to be different, but to reflect a different risk profile. If you can call that a new product, then we'll have it as a new product.
Mm-hmm. Okay, wonderful. There you have it, straight from the source himself, Steve, over at Capitalstackers, the managing director. If you have any questions for him, call the number on the website, capitalstackers.com. You can get through, ask him anything you want. I'm certainly very impressed, and I think you're doing a great job over there, and I'll be interested to, I guess I'll have to sign up for an account this week. I got my fingers dirty. I'm doing some gardening. And then, you see that? That's a scar. There you go. A real man's working finger.
Wow.
See? Yeah. But listen, go have your sea bass. Enjoy your Tesco sea bass. And thank you again for coming. It's really very much appreciated. And hopefully have you back on in a few months. Maybe get an update. I'll have hopefully put in some money. I can ask you some questions about my own experiences, and we'll go from there. Does that sound good?
No, that sounds fine. Thanks for your time, Lawrence.
Thank you very, very much.
And thanks to your listeners as well.
All right. We'll speak to you soon, Steve. Thank you.
Cheers. Okay. Bye now.
Bye. There you have it. Steve Robson from Capitalstackers. I tell you, it's when I saw his due diligence that they go through that, I was really impressed. Normally, I know every company goes through a ton of due diligence, but they don't always show me exactly what they do, so Steve did, and that's why I had him on the stream. I hope you found this information helpful to possibly finding another avenue for your hard-earned spondulics to put them into use, and so you can beat that bank rate, which I think is about 3.5% at the moment, which inflation is almost 10 or over 10. You need to figure out how to bridge that 3.5% to that 10%. That's a big gap. So anyway, back next week with Assets Exchange. Peter Reed, friend of the show, will get an update on what they're doing over there. Ask Peter some questions. If you have questions too, you can submit them early through the Facebook group or ask them live on the Q&A next Thursday. But that's about it for now. So please, again, subscribe to the channel if you haven't already. And I will see you guys next Thursday evening. Have a wonderful weekend. Take care. That's all I got. Bye-bye.